CPI report that came out on Friday morning, and Derek, it was just flat out hideous.
Right. It really was a bad number. There are many people that thought that inflation had peaked in March. And while the core rate appears to have peaked, when you look at CPI and include food and energy, we're up 1% versus April, 8.6% year over year, which is the highest rate of year over year increase since 1981, which is actually the year I got in the business.
So it's kind of your fault then, I suppose. But no, seriously, I mean, it has been a big number. And, you know, when you look at the report, Derek, I mean, there's some things that just make your eyes pop out. You know, food up 1.2%, 10% year over year. Energy up 3% for the month, 34% over the last 12 months. Gas up 50% over the last 12 months, and that's really what's hurting things.
Well, and fuel oil, you forgot to mention that one, up 106%. So that's obviously a problem for airlines and transportation companies generally, which use diesel fuel. So these inflationary pressures continue to persist. And while we still believe the U.S. core rate is still too high, it certainly leads the way to conclude the Fed's going to certainly raise rates by 50 basis points next week on June 15th and another 50 on July 27th. Then we'll see what they do in September. Many people believe they'll raise it 50 again. Yeah,
I think and there's also going to be a conversation, I believe, of a 75-point hike, because right now the market rates are way ahead of what the Federal Reserve is at. And I think we need to explain that to the listeners, because the right now the 10-year Treasury, for example, is over 3%. And of course, the central banks clearly are not there yet.
Right. And when you think about the two-year reached its highest level since 2008. It was trading at 3.04%. So when you compare that rate to where the Fed funds rate currently is at 75 basis points, the central bankers are clearly behind the curve and they're trying to catch up. But a lot of the rate increases have happened. So, you know, as the market relates to these headlines and the fact that the Fed is likely to raise rates, you have to kind of have a balanced perspective, because in many ways the bond market is already adjusted for this.
Yeah, and the central bank is just trying to play catch up. But you know what's really interesting, I did forget to talk about, for example, fuel oil up 106%, because as you said, you know, trucks run on diesel, and that's part of the fuel oil, and that's how you transport goods. That's how you get to, you know, the stuff that's in Target and at the grocery store. And when those costs go up, those costs get passed on to the consumers, and that's part and parcel of the inflation problem that continues to happen. But you mentioned something I have to go back to. You mentioned the 2-year rate and the 10-year rate, and I think that deserves attention.
Well, it certainly does. I mean, we're talking about a potential inversion of the yield curve theoretically if short-term rates continue to rise relative to longer-term rates. But typically, the key rate that people focus on for an inversion of the yield curve is a 3-month T-bill versus a 10-year, and that's a long way away from inverting.
Yeah, and of course, the reason why we watch the inversion, Derek, is because it has been a harbinger for a recession in the past. So we're going to continue to look at that number and pay attention to it, because bear markets and recessions have historically been leaked. And folks, if you go through your portfolio right now and you're concerned about what's in there, there is something that you can do about it. And that is, of course, going through and making sure that your assets are placed in the right sectors. And that's all about asset allocation.